Good morning, everyone, and welcome to the faiVLive in conjunction with FinDev Gateway webinar on assessing the future of microfinance as a development tool. This is a follow-up webinar to one that we had in July with FinDev Gateway with a couple of changes. Sophie Sertain from CGAP has joined us and Upoma Hussein from BRAC Rwanda Microfinance, taking the place of Bridget Doherty from BRAC, who was here at the last one. But that webinar that we had in July was wildly oversubscribed. We had, I think, more than 900 people live, and we did a poll at the end. Would you be interested in hearing more about this topic? And of the 700 or so people who answered, the response was like 90% of people said yes. So it only took us 3 months to find a time on the calendar that we could make it. Apologies to our Jewish colleagues that this inadvertently fell on the Rosh Hashanah holiday. And so I know there are some people who would have liked to be here, but are not able to be here. But this webinar is being recorded and will be on demand and available later on YouTube and from FinDev Gateway. A couple of other housekeeping notes quickly before we jump into it. Encourage you to use the Q&A function to ask questions. We'll see those as we go, and we'll try to integrate questions from the audience. But it's also set up so that other people can answer other participants' questions. So if someone asks a question and you have an opinion or idea about that, please do feel free to weigh in directly. You don't just need to wait to hear from us. In the chat, Laura, that's still just a host and panelists, by the way. I'm not sure if you were planning on sending that. So my colleague Laura is going to be posting some resources related to the things that we are talking about today from the last webinar and some related topics. Now, quickly to introduce everyone, with us today is Andre Simon, President and Global CEO of Finca International. Greta Bull, here you can tell I don't have enough screen, so I don't have the official titles of her. Greta Bull, who is the leader of the Women's Economic Empowerment Group at the Gates Foundation. Greta, are we calling it the Gates Foundation, or are we still calling it the Bill and Melinda Gates Foundation?
The Gates Foundation is fine.
The Gates Foundation. Sophie Sertain, who's the CEO of CGAP, and Upoma Hussein, who is the president of BRAC Microfinance Rwanda. I'm Tim Ogden. I'm the Managing Director of the Financial Access Initiative. And if you don't know who I am, I'm not quite sure why you're here. So let me get right into it to get us starting off. I'd like to ask each of you just from the start, relatively quickly, to talk about, one, thinking back from the early 80s and the birth of the modern microfinance industry, what is the best, greatest, most effective, most useful innovation? You get to decide how exactly you define that innovation in the microfinance industry since this modern iteration emerged. And second, what's been the most disappointing lack of innovation, something that you thought was actually going to make a difference, or you would have expected some change that hasn't happened, or hasn't had the impact that we might have thought it would have? Andre, I'm going to be mean and use alphabetization and turn to you first.
No, that's great, because I'm afraid that people are going to steal what I'm going to say. So I'm happy to go first. Look, I think the biggest innovation has actually been agency banking. It has been the introduction of POS devices that have placed the ability to transact much closer to consumers who don't themselves have access to digital services. Has radically changed a number of things. One is the cost to the customer. We know at Finca that on average it was costing our customers $2 to travel to and from branches, and then it was taking them away from their businesses and their homes for several hours. So there's a cost savings. There's a huge cost savings to the institution, obviously, because now we don't have to build big, cumbersome branches that are regulated, that require a lot of capital investment. And then the last thing is the safety and the security and the convenience for the customers. So for me, it's been the biggest, most transformative thing. We've also learned a lot about what is actually beneficial from placing those agents closer to our customers, is that they also feel themselves more included in their own community. We've seen an uptick in the number of women who are banking as a result of that because they know that they can go to another female agent in order to make their transactions. So huge, huge, huge impact across the sector. Not universal, but definitely in a lot of markets. Do I get to take the bad thing now too?
Yes.
Yeah, nano loans. I would say consumer credit and nano loans had a devastating impact, not just on the consumers. We know that 10% of the consumers in Kenya are blacklisted as a result of having taken on consumer debt. We saw terrible effects across all of East Africa. The loan sizes were too small. They didn't really meet people's needs. The costs of them were far too high. The default rates were exceptionally high. I think that there was a sincere hope that by giving people faster credit, that they would be able to use that in a responsible fashion. But really, what we found is that it resulted in, I think, a devaluation of the microfinance sector because we were all lumped in there together with that. And not only had a terrible impact in terms of consumer behavior and the impact on those customers, but also in the overall reputation of the sector.
Thanks for that, Andre. Clearly, you read some of the pre-questions and had put some thought into that. Greta, what are your thoughts on this?
Okay, so I'm going to take a different approach because I knew Andre was going to take digital consumer credit, and I'm not going to talk about innovation so much, but about places that have got it right and why they've got it right. And I'm going to take one example of Edificar. People may or may not have heard of Edificar, but Edificar is a Peruvian microfinance institution that was founded by CARE in 1998 by an NGO. It grew to about 522,000 clients and had a loan book of about $874 million when it was acquired by Banco de Crédito de Peru in 2009. That was then consolidated with Mi Banco at around the same time, and they now have a big microcredit operation. And wisely, Banco de Crédito kept it separate from the bank's balance sheet, because when it gets pulled into the bank's balance sheet, it eventually turns into a consumer lending operation. And Edificar is not alone. There are lots of successful microfinance operations around the world. I could point to BRAC in Bangladesh. I could point to the whole BBVA Foundation network. I could point to the Women's World Banking Network in Colombia. I could point to Bandhan or other financial institutions in India. There are lots of successful microfinance operations, and they are banking the poor. So I think we sometimes forget that there are a lot of successes in this space, but that success was built on multiple foundations: a market environment that was favorable, affordable, low-cost local currency financing, strong leadership. Edificar, they built that from nothing, right? And so, the ability to kind of run a financial institution professionally and access to good data. Credit bureaus in Peru are very good too. And so that ecosystem came together in a way that supported financial institutions to grow, become banks, and serve the poor. Where I think we fell over was in Africa. And I was partially implicated in this. There was a whole push to do greenfield MFIs in Africa, where we basically started tiny little MFIs. They were registered as banks from the get-go, in a market that was demographically really, really different and harder to work in. And we expected it to be successful when we had thrown tons of money at this in Latin America and in South Asia for years and years and years. And we just thought, okay, this will be commercial in Africa. It'll take off. It'll be fine. There are lots of poor people in Africa. They'll want financial services. And that turned out to be wrong. They've all stayed pretty small. I think the sector's pretty weak in Africa. And, Andre talked about digital consumer credit. I think that's been a confounding factor. I think the whole payments ecosystem that's kind of quite separate from banking has also been a confounding factor. But I think we have just got it fabulously wrong in Africa. And that's a lot of what the paper that we produced is about. Like, we need to rethink the way we do this.
Thanks, Greta. Sophie, I'm just going to give you a warning that after this, I'm going to come back to you specifically on one of these points that Greta made about the investments in the industry. But let me start with you on this innovation question, the most successful innovation in the microfinance industry and something that's been disappointing.
Thank you, Tim. And thank you for having me. So for me, the biggest innovation has really been the mobile money development, especially in Africa, which complements well what Greta just talked about. We know today that mobile money has reached 1.8 billion accounts. It transacts about $1.4 trillion per year, and that is mostly with low-income, poor families in developing economies in general. But we also know that in terms of impact, it has really been a very effective way, for instance, to transfer social safety nets during COVID. It reached millions of people at the time where they needed more. It also reached people with, families and friends, transfers, remittances during climate events. For instance, in Mozambique in January 21, that's where people got their first support. So it has contributed to increasing resilience. We also know that it's contributing to women economic empowerment and agency by allowing them to be active financially despite the existence of social norms in some countries. I also believe that it could become one of the main ways that climate finance could reach the hands of those who need it the most and really create global climate action. So I think it's been revolutionary. Of course, it has drawback, and we can talk about that in the future, in the rest of the conversation. For me, what has been the most important disappointment is the very slow pace of digitalization of the sector, especially of the smaller institutions. And of course, we know why. We know that it's costly, it's difficult, they don't have the skills. We know all of this. But it is, for me, what could lead the sector to really transform its economics, get to better products, to more people, more tailored to their needs. And especially, I think it has the potential to transform the interest rate story. And so that could be transformational, but it's not happening very fast. Stop here.
Thanks, Sophie. And one of the early questions we have in the Q&A is about why digitization hasn't transformed into lower prices as quickly as we might think. And I definitely have some thoughts about that, but yeah, that is something that we'll come back to. Upoma, I'll let you sort of take the last swing at this question.
Thanks, Tim, and thanks to the Financial Access Initiative for inviting me to this panel. I'm very excited to discuss this with all of you. Now, for your question, I think I'll avoid superlatives and say most successful, most disappointing, because I think a lot of these innovations and microfinance industry has gone through some hype cycles, but all of this we should take with more nuanced, sort of context specific. So I think in terms of defining success from BRAC's perspective, we say impact at scale. So how do we reach more women in hardest to reach areas with products and services that are responsible and impactful in their real lives? So the answer on sort of success and failure would probably be around impact and scale. And I think overall, the microfinance sector has done well or sort of better than other financial service providers is that it has self-corrected itself quite a lot. Since it lost its way around 2000s, when the microfinance crisis happened in India and other places, there's been a lot of coordinated effort on social performance, on client protection, on financial education for low-income, low-literacy clients. Honestly, a lot of this, I think the sort of big banks in rich countries could learn from. BRAC obviously takes it very seriously. When you work with low-income women, low-literacy women, mostly in rural areas, it's something that we have to take seriously. And now with a lot of new innovations around methodologies like lean data taking off, we are better able to hear from our clients more consistently, better, and make sure that our services are adapting to their needs. Now, what I think we haven't done very well is figuring out the scale. Sophie talked about mobile money, Andre talked about the agent banking. I think traditional MFIs, which are still very, very important, particularly for women in hard-to-reach areas, has not been able to effectively take advantage of this technology to really push the scale, particularly in Africa. And in Bangladesh, obviously, we are very large. We're over 9 million plus clients. Outside of Bangladesh, we are serving over 850,000 clients in 7 countries, mostly women. So 97% of all our clients are women. And in some of these markets, we are fairly large. We are one of the largest providers. Even in Rwanda, where we are fairly new. In terms of number of clients, we are one of the largest microfinance providers, but we are still barely scratching the surface. We are nowhere close to closing the access gap. And what I mean by that is, for example, in Rwanda, over 90% of adults are using mobile money. And since COVID, these transactions by mobile money has gone skyrocketed. And this represents a great opportunity, but we are not using this opportunity effectively to put liquidity and capital in the hands of women in hardest to reach areas. There are players and fintechs who are providing capital through technology, but those capitals are not going to the target people that we are targeting, the women living in poverty. So we really need to figure it out. We need to figure it out soon. How do we innovate our models to reach the people that we want to reach?
Thanks. Anupama gets 2 gold stars for mentioning sort of pet things of mine. One is that I started my career at Gartner, which is the organization that invented the hype cycle, which is just a diagram of showing how when an innovation comes along, people get really excited about it and generate what are called inflated expectations. This new innovation, digitization, is going to solve all of the problems of microfinance. And then you realize that actually it doesn't do all that. And then everybody turns against it. Everybody promised the moon and it was worthless. And then eventually it gets to realizing here is a tool that helps us accomplish certain goals. It doesn't fix all problems. And then, second, recognizing that there are a lot of lessons for the United States from the global microfinance, but also coming the other direction, that there are a lot of lessons for global microfinance from the history of trying to get financial services to low-income populations in the United States, and the recognition that that has always been a challenge. It's not as if we have ever figured out all of these problems in any economy anywhere in the world, no matter how rich. Reaching the marginalized is still a problem. And so that's why we want to talk some about our topics today. But Andrea and Upama, I want to follow up with you that, I think one of the striking things here when we ask about what are the most interesting innovations is none of them is we change the core contract, we change the core product. And so there is this amazing innovation in modern microfinance of figuring out how to build all of these organizations and spread it across the world. But by and large, and I recognize like I'm oversimplifying here, by and large, the contract is still the same. It is a fairly fixed price loan with fairly fixed repayments over a fairly fixed amount of time without a lot of individual change. And in the meantime, economists in my world have been doing all of these experiments showing, oh, if we change the contract a little bit, if we make the loans a little bit larger, if we, for some of the borrowers, if we delay repayment by 3 months, if we give people a coupon that allows them to skip a monthly or a weekly repayment 3 or 4 times over the course of a cycle, any of those innovations yield better outcomes for clients. But everywhere where these experiments have happened, as far as I'm aware, as soon as the experiment was over, the MFI canceled the innovation because, as far as I can tell again, it was just too hard and expensive to change the product. But given that the two of you are in this day by day, trying to figure out how to offer a product that you can sustain, that gets to scale, that fixes these, that reaches the people, Upama, that you talk about, how do we get to these people who are marginalized? I'd like to hear from you, like, what are the challenges that you see, the primary challenges to taking a changed contract, a changed product, and getting it sustainably in the hands of borrowers? Go ahead.
Yeah, thanks.
Go ahead, Upama.
Thanks, Tim. Oh, sorry, who's going first?
Upama, you go
Fine,
first.
Okay. No, thanks, Tim, for that question. I think I'll first say that it's not that there hasn't been any innovation in contract at all. I think at BRAC, at least, we take the human-centered design approach and we do small pilots. We try to understand what cash flow needs our clients have, and how they interact with different terms and conditions, and how easy it is for our staff to also administer them before we scale certain products. And we have been fairly successful with, particularly with sort of smallholder farmer financing pilots in African markets, also in Asia. But I would answer your questions on the challenges from two sides. One is institutional change management, and the other is client level change management. And I think institutionally, one of the strengths of sort of traditional MFIs, it's its simplicity. When you want to scale a service for hundreds and thousands of clients or millions of clients, it's easier to keep things simple. It's easier to train people. It's easier to monitor. It's easier to reduce mistake and then achieve economies of scale. If we were in a business of giving 50 big loans and make profit out of it, we could have done a lot more innovations. And secondly, some of this sort of customization, flexibility that you were talking about, it takes robust back office systems, technologies, access to data in a meaningful and insightful way. And these are heavy investments, not just financially, but also time. These are multi-year projects, and people's attention is required, right? It's not only about hiring 2-3 IT professionals or business analysts from banking industry, who are very expensive, by the way. But even if we had all the money and we could hire all the expertise, the change management has to go through the entire organization. And when your attention is split, and if your core business is affected or suffers a bad result because of this change management, you have low confidence. And people get wary of this sort of changes and innovation. So there is a lot that sort of institutionally managing change is never easy, but for large scale projects, it's even harder. For client side, at least for Bragg, the profile of clients we are targeting, low-income women particularly, they also prefer simplicity, or rather, I should say consistency. So one small example I'll give, like, our clients know how to calculate flat method interest rates. So when we switch to reducing balance method, even though it's more flexible for them to understand, like a little bit delay or early payment, your payable is reducing or increasing, that confuses them. So the more flexibility we bring, the more we make it customizable, grace periods, repayment frequencies, top-up facilities, whatever you call it, it will be harder for our clients to understand and adopt this change. Not that I'm saying that all clients are same and they all need the same product and they're all going to be happy with it. And should we be tailoring our products? Absolutely. But we need to do it in a way that we understand both our internal capacity and our clients' capacity to manage that change.
Thank you, Upoma. One of the things I just sort of weighing in there, talking about the difficulty of clients understanding. Again, sort of thinking about this problem globally, I recently read a report about customer service in the insurance industry, the consumer insurance industry in the United States, that asserted, and I have no way of verifying this, but I have no reason not to believe it, that 75% of customer service in Allstate, State Farm, the big insurance, is people calling after they've had an accident and trying to change their insurance contract to cover the thing that they chose not to cover in the first place, and not understanding that you don't get to buy insurance after the accident has happened. So this isn't a poor rural women in Rwanda don't understand declining balances. Most people in the world don't understand how financial services really work in a consistent way. And so I think one of the things as an industry we have to understand is there isn't some magic tool that says, oh, if we offer a little bit of education, we're going to finally teach people how to use financial services. That's just, it's not going to happen, and not probably the best use of resources is trying to teach 1 billion people how to calculate declining balance interest payments, as opposed to other things we could be doing. So Andre, turning that to you from your experience looking at the Finca global product, you do potentially have opportunity to scale things in a way that other MFIs don't, but that presents some challenges of its own in terms of figuring out what innovations you deliver and how you deliver them.
Yeah. Well, certainly, and there is regulation that's different in every single market, which is has been up until very recently a significant challenge. And I think that, you know, one of those challenges of innovation that we need to really think about is in these very small markets, kind of going back to what Upoma said, you know, the cost of innovation is actually quite high. And if you can't take a product and move it into other markets, then the size of the market is really relevant to whether or not you're going to be able to undertake that innovation. I think the one piece that I wanted to add to what Upoma said, because I completely agree with her, change management, number one most important thing. Most of the processes inside microfinance institutions are manual. And so when you change something, it has to go all the way through the system up to the education of the client, which is cost prohibitive in a lot of instances and takes a lot of consistency. And also technology. You know, in our case, making changes to products requires us going in and making changes to our core banking system, which is pretty onerous and not easily adaptable. And that's the case for most microfinance institutions. But I think the other piece that we didn't talk about is risk. You know, most microfinance institutions, especially the small ones, operate on pretty thin margins. They don't actually have the ability to take much risk. And so I know I'm jumping ahead a bit to this question of subsidy, but unless there is some give that's created in the system that actually allows institutions to take a chance on doing something differently and to test the impact of that in the marketplace, it's going to make them stick to what they know and what they know they can manage over time. And so I think particularly given that we know that we haven't quite figured it out, we know that there are definitely benefits to it, but that there are improvements that need to be made. I think that where we can all focus as an industry is, well, what are those innovations around grace periods? What are those innovations around collateral? What are the changes in terms of loan size that we can now test more intentionally? But that's going to require support.
Thanks for that, Andre. And I will comment for listeners, please do keep adding things to the Q&A. There are some really great questions in there. We're clearly not going to get to all of them in the course of the next half hour-ish as we go here, but commit in advance to stay tuned because we will try to work through some of the answers after the webinar too, and make sure that we can share some of those. You know, Sophie, you know, this point that Andre makes is low margins, low capacity for risk, and Upoma raised the internal capacity. You know, I don't think anybody serious would argue that investment in the financial system in developing countries at a macro level, so that you have institutional capability, regulatory capacity, all these things, isn't a key thing that actually requires subsidy to build. But then, you know, when we come to microfinance, it seems often well, why do they still need subsidy? You know, yes, there are people who complain about the way we bail out banks and global financial crises, but I think most people here would agree that it's probably better for banks to continue to exist than to fail. So why do you think we remain in this place where people seem to question the idea even of any subsidy support for the microfinance industry, so that you get these answers to these questions of human capital in the MFIs or of, you know, risk tolerance that Upoma and Andre raised?
Well, I think I'll come back first to the first question you had around what has really hurt the microfinance industry historically. And then I'll talk about where I think there is a real need for subsidies, because I totally agree with everything that was said in your question. You know, I think ultimately what has hurt the industry is really the high interest rate. I'm not arguing for interest rate caps. I'm not arguing for interest rate subsidies. And everybody understands the rationale for the high interest rate, the cost recovery angle, the risk mitigation angles. But I think ultimately, we always felt that it wasn't right, that for us had to pay that. And that's what has allowed journalists and socially minded, you know, institutions to pick up on stories where people were not doing well even after taking a loan. And of course, what Andre mentioned at the beginning, the nano consumer loans and the saturation of microfinance in some markets like Cambodia have not helped. But if you look at the evidence, so I'm just going to talk about a piece of work we're doing that I hope can help the industry in that respect. CGAP is launching on October 28 an Impact Pathfinder, which is going to be an open source database that has basically reviewed all quality evidence on the impact of microcredit, not just microcredit, sorry, microfinance, all instruments, on different development objectives, including resilience, women economic empowerment, access to financial services, etc., jobs and entrepreneurship, and the overall evidence is positive. You know, we really have strong evidence that microfinance, including all 4 products, do in overall lead to positive outcomes on resilience, on women economic empowerment, on entrepreneurship, etc. There are caveats, there are moments, there are conditions of markets, there are situations in which the impact isn't always as positive, but there are also solutions. And some of the solutions, for instance, Andre mentioned in terms of flexible repayment rates, etc. So I think first, the industry has been in a way penalized by the lack of a strongly communicated and agreed granular narrative on impact. And I think we need to correct that. We need to talk about where we have this evidence and what impact. It's not poverty reduction. It's not a magical bullet to take somebody out of poverty on its own. But we need to strengthen that impact narrative. It really does help with resilience. It really does help a small firm to survive and become more sustainable. It really does help women get economically active and gain agency, etc. Now, where does that lead us in terms of subsidy? I think, you know, the principle to subsidize the industry is no different from the principles that are well agreed upon for other financial institutions, which is basically that subsidies are needed where there is a market failure or where there is an innovation that the private sector would not be able to address, but where with public support, there could be basically acceleration of progress towards the SDGs, to put it at the highest level, where there is a positive social impact. So I think there's 3 areas where I see a real need for subsidies, but also a real justification for subsidies. The first one, I think, results directly from all our conversations. It's really on the digital divide front, on the digitization front, on the connectivity front. So we all agree that part of the solutions to reach more people, to improve tailoring of products, to reduce costs and possibly reduce the interest rate, will go through digital solutions. But we all agree, as you know, Paul and Andre discussed, it's incredibly difficult and costly. So I think first we need subsidies to bridge the digital divide, to bridge the connectivity gap. You still have 2.6 billion people in 2023 without connectivity. Access to a smartphone remains a major problem for the poor. The cost of an entry-level mobile service, I mean, data from the World Bank show that it's 55% of the income of the 20% lower income strata group in developing country. That's massive. So first, bridge the digital divide, possibly support the digitization of small microfinance institutions that won't do it on their own, but that could indeed then leverage progress at scale. Develop the enabling environment, the data infrastructure, the open finance frameworks, the consumer protection, the financial literacy, all of these regulatory and policy frameworks that would enable further progress at scale. So I think that's the first area. The second is really where the needs for innovations are the greatest, where microfinance institutions need to innovate but don't have the skills, the time, the resources. So such as, for instance, climate-related products. we hear from all our microfinance institution friends that their clients all over the world are increasingly impacted by climate change, and they're all developing products, but it's not easy. They don't have the time, the resources, etc. So subsidizing the innovation of new climate adaptation, climate resilience product, and subsidizing their intake by the poorest clients, such as insurance premium subsidies, because as you said, Tim, people don't buy insurance unless it is really first well explained, but probably subsidized. And I think the third area is really thinking about the segments that are really the poorest. And I keep wondering whether we shouldn't segment better and see them more as those that will receive basically social safety nets mostly, and where microfinance services will be a complement to social safety net in a graduation program type of approach or in a bundling approach. So instead, I'm not talking about subsidizing interest rate for them, that is distortive. But at the same time, we may need to recognize that some of the poor segments are not ready to be served in the same way as others by commercially oriented entities, and that social safety nets, which are subsidies fundamentally, are really necessary. And I think recognizing that and segmenting better the client base, and then allowing for a graduation approach where they move away from safety nets up the scale of products might be a good approach in some cases. I'll stop there.
I mean, any of these questions, we could do an entire webinar on just the one question. And so, I'm feeling every time there's an answer, I want to stay on that answer, but I also want to sort of cover some broad things. I do want to encourage everyone listening using the Q&A to answer each other's questions too. There's a lot of knowledge. If you could see all of the people who have registered for this, there's a lot of knowledge in the microfinance industry listening in. So please do feel free to answer or comment on other people's questions as we go. But Greta, I'm also now of the age of, like, it doesn't feel great when people say, you've been looking at this for a long time, but you've been looking at these things for a long time and thinking a lot, both as when your former role at CGAP, your role now at the Gates Foundation, what makes a strategic investment for you as you have, surveyed and seen lots of different approaches to providing subsidy in the MFI industry, and now at a place where you're setting strategy for major investments. How do you now think about what's a strategic or smart subsidy and what's not? And if I can tack on just a little hobby horse question of mine too here to this, given where you sit, how much progress do you think we've made in moving away from women as a tool? So we should give credit to women because they're going to do something else that we like, as opposed to we should give credit to women because they're human beings. We should give access equally to every human being, not because we like what they happen to do with it on the back end. So those are two kind of big questions, but I trust that you can pull out an answer.
Well, really big questions. And actually, I'm going to build on something that Rafe Mazer put in the chat, because I think it's exactly the right question. So Rafe asked the question about subsidies and those who argue against them. It's partly a question of trade-offs when you're talking about philanthropic or subsidized development funding. That money could go to schools, hospitals, and unquestionably positive social goods. Has there been any comparative cost benefit of using philanthropic funds for microfinance subsidies versus other social needs? I think that's exactly the right question. And that's the question I get posed all the time, because my boss really likes health spending and sees a lot of positive social good in health spending. I have a couple of answers on the subsidy point, which may or may not satisfy people. I do think, so I think microfinance has suffered from hype. It was going to solve poverty. No, it's not going to solve poverty. It's a financial service, for goodness sakes. And so, think of it as a financial service, and people need financial services and use financial services. So I think that's an important starting point. I also think, to Rafe's point, if we think about it the right way, you can get a lot of leverage out of your subsidies by deploying them in the microfinance space. But then you have to be very careful about how you do it. and don't distort. But I think this don't distort thing is often a get out of jail free card for people. We distort the economy all the time. Subsidies often go to the big industries. Preferable lending goes to the big industries. Look at the balance sheets of banks in Kenya right now and tell me, do you think KQ is a good investment, right? And so, like, I think it's a little bit of a fake argument. I think we have to be careful about subsidies and we have to be surgical with subsidies. But I would point you to India, for example, where they have a priority sector lending mandate. It's a little controversial, where 40% of lending has to go into certain preferred sectors. And they put subsidies into that. So women in the SHG ecosystem, the SHG ecosystems, I would remind you, reaches 100 million women. That's a lot of people. And they subsidize those interest rates. So women borrow at between 7 and 12% interest rates. And that is because the government puts an explicit interest rate subvention into those loans, and they help manage those loans. The repayment rates are pretty good. Now, those are group loans, and they aren't as flexible as some of the other products we're talking about, so they're not fit for everybody. But, you know, if you're faced with borrowing at, I don't know, 70, 80% on a digital consumer loan in Africa and a 7% loan as part of a self-help group in India, I know which one I would choose. And I think we all have to ask ourselves who work in the formal financial system, why is it that so many women in Africa prefer VSLAs, chamas, other forms of informal finance? Because it's better. The rates are better. You're dealing with people you know. And so I think, you know, there is a real challenge to the microfinance sector, particularly in Africa, to understand how we use subsidy. We do not want subsidy to be misused. But I think what we've seen in Kenya in particular is what happens when you let the market do what the market does, right? You get, you know, banks doing a thing, you get consumer credit that's digitally delivered at very expensive rates. And why don't those interest rates come down? Because they don't have to. I mean, I think it's simple as that. They have high loss rates, but, you know, they don't have much of an incentive to bring those rates down. Very capital light. You just churn it and you make money. But is it productive? Is it developmental? No. Is it like a credit card, a thing you can fall back on, an insurance policy? Sure. We need all those things, right? But we lack productive credit in a lot of Africa. And I think we have to find ways to encourage productive credit. So to build on what Sophie said, I think donors can put a lot into building the regulatory landscape, the data landscape, for God's sake, competition policy, because right now, I mean, the MNOs are like hogging up the whole thing. Do we want MNOs being financial services providers? I would argue no. And I think there are some institutional things. I think, but, you know, I think microfinance institutions also need to look into the mirror, because donors have funded some of those experiments in digitization in the past, and they've gone horribly wrong. And so, like, we need to make sure that where we place subsidy, that we use it well, right? So if we're working with an MFI to digitize, okay, you put some money on the table too. I want to see your plan. I'm going to assess that like an investor. I'm not going to assess that like a donor. And so I think we have to think a lot smarter about how we subsidize, but we also have to remember that microfinance in places like India and Latin America was built on decades of subsidy. Decades, not only in the form of wholesale financing that was affordable, but also support for regulatory frameworks, just funding. Like when Edificar was sold, there was a huge argument because whose equity was it? Like, you know, and so we haven't done that hard work in places like Africa, and I think we need to. And now we have a lot of fragmentation because we have a lot of different players in. And so I do think there is some hard, cold staring in the mirror that we need to do. To your question about women, you know, it's funny, Copa was here with us yesterday. Jesse Moore was here, and he was saying, you know, we want to do more lending to women. They've got a smartphone product. They sold 2 million smartphones last year with their kind of pay-go asset financing approach, and they cannot literally build them fast enough to sell them, and they're expanding. And I think a good story, but they really like lending to women because women are careful consumers. They ask questions. They're harder to sell to, but once they sell to women, they pay it back. They're better agents for Copa. They're better borrowers for Copa by 5–10%. The repayment rates are that much better. And so, like, we misprice risk for poor people generally, and we especially misprice risk for women. And so, you know, we know that women don't get equal access to credit. They don't get equal access to the financial sector. They don't have equal access to mobile phones. And so I think we have to ask ourselves why. And I think we also have to ask ourselves why women prefer chamas and VSLAs, because it's a better service for them in a lot of cases. And so I think we have a lot of work to do to provide the kinds of products that are going to be relevant for those women, and to build the kinds of institutions that are incentivized to serve those women, like BRAC, like FINCA. But we need them to get bigger. We need them to get stronger. We need them to be more digital. And so I think there's some lifting that needs to happen, but we also need to recognize just how hard it is and that this is an ecosystem problem. It's a funding problem. Look at the cost of funds in Africa right now. It's a regulatory problem. It's a competition problem. It's a digitization problem. And so we have to kind of tackle all of those things in one go, especially if we want to reach women.
I can't believe I'm saying this. We've got 15 minutes left. I think we just got started, but we've got 15 minutes left. I want to throw in a quick advertisement here that at a British International Investment meeting last week, I formed an informal cooperative with Georgia Barboni and Mohammed Mekki, who are two researchers, to advocate for and do research on institution building in MFIs. Recognizing what does it actually cost an MFI to reach a new market, to hire and train loan officers who can do different kinds of underwriting and different kinds of loan servicing. What does it actually cost an MFI to deploy and maintain a new digital platform for flexibility or for payments? And so any of the funders who are out there, or any of the MFI leaders who are out there who would like to join our informal cooperative to advocate for the kinds of institutional research that we have not done at all. So one of the things that's really remarkable to me is often if you look across the headline research in microfinance, it's all about contract innovation. It's not about the NMFIs. And one of the most successful things we've done is we built all of these amazing institutions in all of these places. And then we decided we shouldn't invest all that much in studying them. Now, I want to be clear, there are some academics who are studying that, but they're not the ones who get the attention. And so it is time for us to raise that question of how do we help MFIs operate better? How do we build those institutions? But also, how do we have realistic expectations of what it costs to do what we're asking MFIs to do so that we can do smart subsidy based on realistic expectations of operations. So I'm going to wrap us up by going all the way around on this question of insanity. And so there's this standard definition of insanity, which is doing the same thing over and over and expecting different results. There's also this version, the inverse of that, which is doing different things and expecting the same results. And so I feel like this applies in the microfinance industry in two ways. One is if we take the historical context, you hear me use the word modern microfinance because we invented microfinance at least as early as the early 1600s. And for 500 years, we've been inventing microfinance, deciding it wasn't worthy of support, and having those institutions focused on quality services for the poor go away, and then we invent it again. So it's insanity to think that these institutions can continue. We have 500 years of history to say, if we don't support institutions that want to provide quality services to the poor and marginalized, they're going to go away. So one is, can we escape that insanity? The other insanity is more critical of the industry, which is we've done a whole lot of not just moving the goalposts, just renaming the goalposts from financial access to financial inclusion to financial health, but still largely done exactly the same thing, hoping that maybe this time with a different set of metrics and a slightly different set of metrics and name, we'll actually get to the goal and not doing things that actually likely to change outcomes. So I'd like to ask each of you, do you have hope that we're going to escape the insanity? And two, what do you think the industry is going to look like in 5 years? How different is it going to look from what it is today? Are we in incremental change, or are we going to see some really big changes over the next 5 years? So that being said, there are 4 of you. We've got 10 minutes. So you got 2.5 minutes to answer the question. Andre, I'm going to throw it over to you first.
So yes, we will escape the insanity. Otherwise, why are we on this call? It's going to be technology. I know that word is terrifying to everyone, but data analytics and the data of our customers, both with respect to impact, but also with respect to targeting and product design, is going to be transformative. It is going to require a lot of subsidy and a lot of collaboration, neither of which we've been terribly good at across this industry in particular. But Tim, I want to come back to this question of like, why do we keep renaming what it is? And I think the reason that we keep renaming what it is that it keeps getting tainted and people are wanting to turn away from it. And the reality is that we know that there is value in helping people who have to be self-employed run and grow their small businesses, and that it creates better communities, more stability, and resilience. And particularly in the context of the climate issues that we're dealing with, in the instability issues that we're dealing with globally, and these questions of migration and food security, if we do not invest in people's own ability to build their resilience, we are going to have more trouble, not less.
I just have to give you a pause for like a very trenchant, quick answer. Well done, Andre. Upoma.
Now I'm having trouble with
You're on
unmuting, but
yeah.
yes, thank you. No, so I think yes, I agree with Andre. We are going to be escaping this insanity. Not that I completely agree with the premise, but because at least if I look at sort of BRAC's history and serving microfinance for 50 years, we still very impactful, still very relevant. Even in our country like Bangladesh, where there are multiple large MFIs. More so for African markets, where there's still a big gap, and we should know by now that these new fancy innovations are not going to by themselves go to the hardest to reach. We will still see the relevance of microfinance, even in times like when there is a constraint on resources because of the climate change, etc. I think microfinance institutions are going to become more important, because even if we do find all the climate finance gap that we have, we need to figure out how to get them to the hardest to reach people. And organizations like, microfinance, large microfinance like BRAC, FINCA, they are on the ground. And ultimately, shock is a shock, and it's an economic shock, and people will need liquidity. And to Sophie's point, we need to strengthen that safety net system and see how microfinance plays a role. I think in next 4 years, we might see model changes, which traditional microfinances have been very resistant to, but I don't think there are much sort of choice. We need to move, at least particularly in Africa, we will need to move toward more innovative models to reach the hardest to reach. But it's not easy, right? Microfinance is not easy, and solving the hardest to reach is not easy. And we will need support. While we want microfinance institutions to be sustainable and viable, we need to recognize that certain innovations and cooperation, ecosystem change has to happen. I mean, BRAC in Bangladesh, even in some of this Uganda, Tanzania, were built on very trusting long-term funding from even institutions like Gates Foundation and MasterCard Foundation. And what that did was they built institutions, even when those donor funding went away. They became much larger and could support other NGO programs, other social development programs as well. More and more, we are seeing that fundings are becoming much short-term, very sort of small ticket size, very project specific. What these do is that they create incentives to not learn and solve problems, longer-term problems, but actually just to report to donors. So we need patience and trust from funders and probably need a lot better thinking around how do we solve the local currency funding in these markets.
Well, so you got your applause from Andre there, Ubola, and very vigorous head nodding from Sophie and Greta. Sophie, let me turn to you on this question. Can we escape the insanity, and how big do you think the change is coming over the next 5 years?
So yes, we can escape it. And I want to reconcile what Andre and Upoma said. So for me, the future is one where we're going to have a large range of different financial institutions serving different needs in different ways, from banks, digital banks that are represented in Brazil, increasingly serving the poor, fintechs, and where microfinance will really be recognized as having a place, a role to play. So I fully agree with Upoma there. But I also fully agree with Andre. I think that microfinance will have to embrace digitization much more than it has today, because I think that is what is going to enable it to reach the last mile. It's not going to be sufficient. I'm not saying it's sufficient. So everything that Upoma said is also going to be necessary in a lot of enabling environment factors. But digitization is what's going to enable microfinance institutions to operate with another economic equation, and will enable them to offer better services, more tailored services, as Andre said, but also better price services. I think we can get to a point where the interest rate equation will just be different. And where, there were questions in the chat about credit score, alternative credit scoring systems, leveraging alternative data, maybe risk pricing. I think this is indeed going to happen, but through the digitization of microfinance institutions themselves, little by little. It's not going to happen in one day. And they will have a key role to play in the ecosystem of financial institutions. Now, one last thing I want to add is that I think we're going to also see much more non-financial services being bundled with financial services in the future. And that will be essential to reach our development objectives. We're going to see, for instance, agriculture aggregators providing market information, pricing, access to customers and to inputs and advice on crops, bundled with financial services at the last mile to really improve outcomes for all these people. So yes, we're going to escape the insanity. Microfinance will have a role to play, but it will require subsidies and a lot of innovation and efforts, as everybody said.
Yep. Thank you, Sophie. And I know, Greta, your internet connection is not as strong as we would necessarily like it to be. I'm leaving you with the last word because we have shared incentive that we both have to run to the airport, and so to not go long. So my final word before I hand it to you, Greta, for the final word is we are going to follow up because there's some great conversation and questions in the Q&A. But also one of the things that I would like people to really be thinking about, because I often hear it proposed as one of the ways out of the insanity, is open banking and credit scores and credit bureaus and things like that. And there are very positives to those things, but there are also very negative possible outcomes for those things when you give more predatory lenders more ways to attack and control and seize things. And so in all of these cases, I would like us as a whole, as an industry, to think about, as we innovate, not only what are the ways this will help good actors do better, but also what are the ways this will help bad actors do worse, and think about that from the start, not after we've seen lots of bad things happen. So Greta, let me leave it with you for the last words on, can we escape the insanity? What are the big changes coming in the next 5 years?
So, boy, I have a minute to cover that. So first of all, I think the financial inclusion industry has sort of sometimes been its own worst enemy, right? If you've ever watched 5-year-old kids playing football, they move in a swarm and chase the ball. They don't play as a team. You don't have defense strikers off, like we need to play as a team, and we need to recognize that what we're trying to do is hard. And if we keep thinking that there's one little thing, there's one shiny new object that is going to solve all the things, we are wrong. We are just wrong. So think about what drives the cost of lending for a microfinance institution. It's the cost of risk, it's the cost of funds, and it's the cost of operations. That is much bigger than just digitization. So I'm going to disagree with my other panelists. Digitization is not going to solve all of this. It's part of the solution, but it's not going to solve all of this. Cost of funds is a killer. If you look at financial sector depth in Africa, Nigeria sits at around 10% private sector, capital of the private sector as a percent of GDP. Kenya's kind of the best at about 32%, but most African countries sit around 15%. The financial sector is not delivering financing into the economy. And so what do? We borrow from external sources, and that is extremely expensive right now. The cost of hedging is ruinously high. So we need better data, and that's going to involve some competition policy. We need better regulation because we do not have good regulation for microfinance across Africa. We do need to digitize. We need stronger, bigger institutions, but you're not going to get stronger and bigger if you don't have an affordable cost of funds in local currency. And so I think we have got to tackle all of those things, and we have to recognize that this is an ecosystem problem, not a shiny new object problem. We've got to get away from that because otherwise we are a swarm of kids chasing a football and not playing as a soccer team. And so I think it's all about financial sector depth. It's about improving access. It's about improving outreach. And that requires us to play as a team. And if we don't get our heads around that, we are never going to crack this nut, because in Africa in particular, I think is a particularly difficult nut to crack. And so it's going to take a concerted effort across government, across donors, across private lenders, to sort of move the needle on this, because we've got to tackle cost of risk, cost of funds, and cost of operations.
Well, thank you. I am just enormously gratified to have shared the stage with the four of you. I am hopeful about the future of microfinance because we have people like the four of you actually advocating for not chasing the ball around, for smarter subsidy, for realistic expectations. And I do think that is part of, as Greta noted, something that we haven't had in the industry. We haven't had people with real operational experience making decisions at the regulatory levels, at the funding levels, at the subsidy levels, and those sorts of things. We haven't had the depth of talent leading MFIs with lots of experience that we're now starting to see develop in a lot of places. And I would comment, Greta and I have had this conversation. The depth of human capital in Latin American MFIs is still significantly higher than it is in a lot of other places. And we see how that plays out in the Latin American markets. And, there are things happening, though, that the depth of human capital in MFI, in the industry across the world, it's getting deeper, and it's getting deeper fast. And so I'm encouraged about that as well. So thank you to all of you, the 200 plus of you who joined us here. We will follow up with all of these amazing questions and comments that were in the Q&A. The webinar, please do share it with others in your organization or others you think need to hear some of these messages. And we will look forward to more of these conversations, going deeper and getting better. Thanks again for everyone for joining. Greta, good luck on your travels. Hopefully I make it to a flight here in Barranquilla and I get home. And I'll look forward to seeing many of you at the CGAP event in late October that Sophie mentioned. Take care, everyone.
Thanks, everyone. Bye.
Thank you. Bye-bye.